Are you protecting your portfolio? In today's world, the stock market has started entering the correction phase, which is a decline of 10% more off of the all-time high. The S&P 500 is in that correction phase. Even looking at the Nasdaq, it is down about 14% from the top. So both of them we are seeing in the correction phase as it sits right now. So stock market volatility can be unraveling, and if you're emotionally tied to it, it can be super taxing to you as an individual. Investors can't completely isolate portfolio from volatility, but we can mitigate some of the risk. And how to do that is through dividend ETFs, which is what we're going to be looking at today. Historically, a lot less volatile than the broader market. And even with the uncertainty of what is coming up in the future with the tariffs, with the on and off, on and off again with the tariffs and everything else we're seeing, a lot of people are very hesitant, but a lot of people are also just pulling all their money out, which in my opinion, I feel like that is a big mistake. So buying an exchange traded fund is a great way to diversify with those dividend stocks in that portfolio. So today we're going to be looking at the Vanguard High Dividend Yield, and we're also going to be looking at the SCHD. Those are two that I do own personally within my portfolio, and we'll go ahead and break down their performance in relationship to that S&P 500. Now, when we look at income producing like the VYM or the SCHD, it aims to measure investment return of stocks with high yield dividends, which means you're getting money based on if the stock goes up or down, you're still getting paid dividends. You're not sitting there, and we know it's about 1.6% for the S&P 500 or the VOO, where you might be looking at like an SCHD that is paying around 3.6%, which is significantly higher, but it doesn't quite have that up and down volatility that we see. Now, the current ETF, the VYM, is yielding a 2.5%, which is double what we're seeing about the S&P 500, which is roughly around that 1.3%. Over long term, stock market tends to outperform the general ETFs overall. But dividend payout ratios when the stock market down is what makes up a big difference. Now, when we start thinking about dividend payout ratios, which offer a significantly higher yield, outperform the market 70% of the time between 1930 and 2023. Then, when you think about the growth of the S&P 500, when you think of the growth overall, a lot of it does come from dividends. So it is companies that are paying investors back to produce the growth. Now, when we think about generating income and stability and really stable returns, a lot of ETFs have utility stocks. A lot of them have banking stocks. A lot of them are not so heavily invested when it comes to the tech side, which is the reason why it does make a very big difference. So let's break this down. I want to look at this and see kind of the comparison of these three ETFs and show you what we're looking at in the future. So let's hop in. I want to add this up to the stage. This is over on ETF.com, and I built this out. So we're comparing the VOO, the VYM, which I do hold in my portfolio, and the SCHD. So thinking bigger picture, I do hold all three of these in my portfolio as it sits today. And looking at the performance of them, it's kind of crazy to think in the shorter term where exactly they're performing. So you notice right here, S&P 500, this is the custom high yield dividend. This is the Dow Jones Dividend 100. So looking at the holdings in general, this is something to note because when you look at the VOO, there's 504 holdings. When you look at the VYM, there's 531, which means they're holding a lot of those custom high dividend yield companies, but they are also dipping into the mid cap, dipping into the small cap to cover all 531 companies. And then the SCHD only holds right now 99 companies, which meet a very strict criteria when it comes to the SCHD. And they do rebalance this every single year. They are rebalancing this month. So we will see this kind of a reconstitution, they call it, to rebalance this. So looking at the cost, very similar. You can see the VOO, very cheap expense ratio, 0.06. Honestly, when you start splitting hairs of a 0.03 to a 0.06, not even really worth it when you look at the yield that you're actually getting back in here. But overall, trade volume, kind of interesting because, again, 179 million here, 390, so almost 400 million here, 2.87 billion, again, average daily volume for the VOO, kind of crazy. When we get into performance, this one is pretty interesting. Now, you'll notice that there is a massive drop rate here. So SCHD goes from 4 to negative 60%. Now, this chart, of course, is because of the 3-to-1 split that we did with the SCHD. So they did a stock split. So again, the NAV return on this is going to be kind of off, but that is where we break it down kind of in a bigger picture. Like we were talking about, the VOO 1 month is that correction period right around that 10%. And it had dipped a couple times past that 10%, but VYM 1 month at 5. And then the SCHD is only at 2. This makes a really big difference in the holding. So when you think, again, bigger picture, a lot of what we're seeing, the pullback, a lot of what we're seeing is in the tech sector. When we look at Apple and Google, when we look at Meta and Tesla, a lot of those companies are still very big on the pullback. And a lot of people are saying this is the correction that was needed within the stock market, just for the simple fact that a lot of the stocks, a lot of those tech stocks were very, very high overvalued. This brings them back kind of in alignment with the P/E ratio of where the stock is going to be actually, worth exactly what they're producing. So if you have a company that's making $100 million a year, that's worth $1 billion, it doesn't make sense when it comes to the amount of money they generate in relationship to the value of the company itself. When we look at the 3-month, 8.453, and then of course 3% right there. Year to date though, 5.8, almost broke even and even closer. So down 1% right here. So again, a little bit easy on the year to date. Then we look at the 1 year, again, still looking at last 12 months, 8%, almost 10% on the VYM and only 7% on the SCHD. So thinking about the growth of these larger companies, and of course, this 9.87 that we see right here really does make a big difference, because those are larger companies that are within the top 10 withholdings that are still performing incredibly well. So even thinking of the last 12 months, we're losing, or we've given up a majority of those double-digit gains that we did see in 2024. 3 years goes to 11, 5 years goes to 17%. So thinking about the average performance of the S&P 500, which runs about a 10% average return, still doing incredibly well, still seeing a lot of performance. Even in the VYM, we're at 15 or 14.5, and then the SCHD, we're at 15.5, so performing a little bit better. So again, when we think of investing and when we start thinking of really the bigger picture of investing being a 5+ year time frame, you're looking at a 17% average return in the VOO. And of course, when it comes to any of these ETFs, I do not hold them in their entirety. They are part of a portfolio. I hold the 35% of the VOO. I hold 35% of the SCHD, making 70% of the portfolio right there. Then we do have the QQQM. So it does make a big difference where if the VOO is swinging down considerably, we still have something like the dividend equity, the SCHD or the VYM, that is actually making up a lot of the difference. So it's not as far down, and it's still generating income, which is a big, big factor. Now, when we look at the holdings, again, this is where it gets interesting with the market cap, because you'll notice, even though both of these, the VYM and the SCHD, both of these are very high companies when it comes to the dividend yield, you'll notice most of these names are not in the both of the lists. I thought there'd be a lot more duplicate. You can see Abriva's in here. But looking down here, I don't see, Johnson & Johnson. I don't see the Wells Fargo. I see, MGAN, which again, we don't see over here. Broadcom, I'm not seeing. So there's not a lot of overlap between these. And then of course the VOO, because it is market weighted cap, you can see those 10 companies, and look, Berkshire Hathaway's all the way down here, but Apple, Microsoft, Nvidia, Amazon, Meta, like I said, a lot of these that are just kind of very, in my opinion, overvalued to a point. They're not holding as much weight in the VOO because again, it is market weighted cap. But when you start looking at these in the entirety, that's a big, big chunk of the portfolio. What do we have? We have 6, 12. That's 18. You're probably talking around 40% of the portfolio is probably in the top 10 or 15. And overall, that is the reason why when we see a pullback from the tech sector, the VOO tends to underperform, and it does a lot if you're heavily invested in tech. That's why, like I said, only allocating depending on age. You could do 30, 40, 50% if you did in tech. If you're 20s and 30s, as you start getting a little bit older, I would put it into something just slightly more safe, like the SCHD, that is still doing a pretty good return. So when we start looking, again, looking at the VOO, technological services right there, electronic technology, and then we start looking at the VYM and the SCHD, they get into the finances, even looking at the health here and looking at the non-durable consumer. Very, very heavily invested in those blue chip companies that produce, a regular return on a regular basis. Even looking here, the tech side, again, not a huge holding in the tech side. Between here, you're talking what, 42% in the tech side, 13 right there in finances. Again, these a lot more heavily vested in finances. So you're kind of mitigating the portfolio overall. Even the P&E ratio, that's why I said the VOO, a lot of people are saying that it is well overpriced. 1.3 dividend yield, 2.7, then a 3.6 right there. So again, the SCHD is something that I absolutely love to hold. And I do buy it on a regular basis. We dollar cost average into all of this. So even where we have the VOO that's going down, guys, it is now discounted. When you start looking at these numbers and you start looking at the 1 month, the 3 month, thinking about buying this at a 10% discount, even buying some of these at a 2% discount, even here almost at a 6% discount, makes a really, really big difference when it comes to how essentially discounted you can get that. But all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.